Hello, and welcome to Bracewell's Data Center Counsel podcast. From energy and utilities to siting and financing, our attorneys cover the opportunities and issues with data center development.
Hello, and welcome back to the Data Center Counsel podcast. I'm Jared Berg, happy to be back with you guys. And I've got with me today Jeeseon Ahn and Joyce-Schleimer from our project finance team and Jason Lewis from our projects team. And today we're going to be talking about how to project finance a data center. So with that, Jason, you want to introduce yourself and we'll go on down the line and then we'll get rolling.
Yeah, hi. This is Jason Lewis. I'm a partner here in the New York office. I focus on commercial agreements regarding energy, commodities, and derivatives, including offtake agreements and project financings.
Hi, my name is Jeeseon Ahn. I'm a partner here in our New York office, and project finance partner. I represent banks and sponsor developers on conventional and renewable power project financings, as well as digital infra financings.
And I'm Joyce-Schleimer, also a project finance partner in our New York office. I've covered conventional power, renewable power, and infrastructure, including digital infrastructure.
Alrighty, guys. Well, it's always fun to have another Jared on the podcast. So fortunately...
Indeed, Jared.
Fortunately, we're going to let Jared do most of the talking today. My voice is the last one that y'all want to hear. So let's go ahead and launch into it, guys. What makes a data center project financeable right now?
Well, first of all, it's noteworthy how many different types of financing are available in the market and being applied to data center financing right now. There's a lot of creativity around structuring financing for data centers. There's traditional project finance with some real estate influence, like completion guarantees, but with largely a traditional project finance structure for construction financing. And then at takeout, there's a variety available coming from private credit, private placements, ABS and CMBS. The transition there is that construction risk is gone at that point, assets performing, and then a broader set of investors are comfortable lending.
Interesting. So I mean, is a way to think about it that you're basically securitizing cash flows from future revenue? Is that kind of the idea?
On CMBS and ABS, yeah, that's exactly right. Both are securitizations. So meaning loans or cash flows are pooled and then converted into bonds and sold to investors. So in CMBS, you're securitizing mortgage loans backed by commercial real estate. In ABS, you're securitizing receivables or contractual payment streams. Basically, CMBS securitizes the mortgage on the building. ABS securitizes the cash flow coming out of the building. ABS and CMBS line up nicely for a takeout of project finance construction facilities because the risk allocation and documentation already done under the PF facility. It's aligned with what long-term capital the takeout will expect.
And then separate from the financing structure, I would add that any project finance lender will be looking for a offtake agreement, i.e. a lease with a creditworthy offtaker, which in a lot of cases these days is a hyperscaler, the likes of Microsoft, Meta, and Google. And the lenders will look to make sure that those underlying leases are financeable. For example, they'll want to make sure that the termination rights and assignment rights are appropriately limited. I think one of the things may be on the termination rights that gives lenders comfort. However, even if hyperscalers want some flexibility around termination, would be that for these large-scale data centers, once they've been built to suit, it may be difficult for the data center, the off-taker, to then turn around and step away to another data center. So that might be something that on a commercial level may inherently limit their termination or their desire to terminate a lease. There's also GPU financings that are getting done. And for those, the financeability issue that the lenders have been focused on are the underlying technology obsolescence risk, given that these GPUs have short depreciation timelines. And so they'll want to make sure that they conduct proper diligence on the underlying technology to make sure that the depreciation timeline adequately matches the tenor of the debt.
So is that because you're looking at what the value of the chips are kind of at the end of the day? That seems like an interesting concept that you're effectively backing your loan off of chips. But I guess your point is new models of chips are coming out every year. And so after a couple of years, chips are obsolete, or is it more that these chips are kind of getting burned out after a few years? And maybe you don't know, but I'm just curious.
I think it's all of the above based on what we're hearing from the lenders out there. And so how they will mitigate for that risk would be to build in the appropriate covenants to ensure that there's covenants around minimum availability so that the appropriate adequate default or cash sweeps are triggered. The GPU availability floor falls or the GPU available levels fall below a certain minimum, as an example.
So the idea being that if a chip is starting to perform a little bit poorer, doesn't have the same capacity that it used to, after it hits a certain level, then cash sweeps start coming in. Lenders basically start flexing their muscles.
Correct.
Interesting. Jason, how does this play in? How does the power offtake and kind of utility side of things play in on the project financing from a project financing perspective?
So I think a lot of the principles that Jeeseon talked about apply to the offtake side as well. So when lenders look at offtakes, they traditionally focus on things like assignment rights in order to make sure that they have the ability to exercise remedies against their collateral. They also want to make sure that foreclosures and the exercise of remedies do not constitute a change of control that would be either prohibited or require consent. And they'd also focus on things like termination risk. So in general, making sure that the stream of revenues under the offtake is as stable and predictable as the market will permit. All those principles apply in project financings generally, and we think they're going to apply in project financings for data centers and generation facilities serving data centers as well. In addition to that, from what we've seen, lenders are increasingly interested in making sure that the buyer under an offtake agreement provides sufficient security for its performance. So in particular, where the project is generally backed by a hyperscaler, it has become of increasing interest to lenders and project stakeholders generally as to the underlying creditworthiness of those hyperscalers.
So I guess what you're taking it from a different perspective, you're thinking about project financing the actual generation project. From that standpoint, you have a creditworthy off-taker that is paying basically the generator over time, and that's kind of what the lender is relying on. Kind of the same concept that Jeeseon was talking about.
Yeah, that's exactly right.
Interesting. So, Jared, you were talking about kind of combination of different types of project financings. You have commercial mortgage-backed securities, you have ABS, asset-backed securities. But then I always thought that project finance was basically the same playbook. So I'm curious, what's the differences here? Maybe you can back us up a little bit and talk a little more about project finance in general.
Project finance is asset-level, cash flow-based, limited recourse financing. Lenders aren't underwriting the sponsor's balance sheet. They're underwriting the project's contracts and its ability to generate predictable cash flow. So repayment comes from the project itself, and the collateral package is the project. So the leases, the power arrangements, permits, the accounts. If the contracts hold and the asset performs, the debts get repaid. Debt's also held by a special purpose vehicle that owns the project, so the debt's not sitting on the sponsor's corporate balance sheet. Project finance is used for construction because the whole point of the structure is to isolate and allocate risk from day one. Construction is when the risk is highest. So cost overruns, delays, performance failures. Project finance is designed to contractually manage those risks. In a project finance construction facility, lenders underwrite the entire risk stack upfront, the EPC contract, whether there is a liquidated damages regime, having some contingency in the budgets, meeting milestones for interconnection, power supply, and then ultimately having the revenue contract that'll support repayment once the project is online. And then the financing documents will lock in things like covenants, reserves, and step-in rights before the capital is fully deployed.
Yeah, so for the most part, as Jared mentioned, a lot of the project financing principles carry over into financings of data centers, at least as we've seen so far for the data center, the shelf financings that we've seen at the asset level. Some of the differentiating features we would flag that we are seeing are completion guarantees and loan to value metrics that are being applied. So completion guarantees, we have not seen recently in your traditional project financings in the recent years in the power sectors that we are seeing to cover construction risk in the data center space, which we have heard the lenders say could probably be financed without. However, it is a carryover from the real estate financing space that we're continuing to see. Loan to value metric also is more of a real estate financing metric that we don't typically see in a non-recourse project financing, but however, with sort of the hybrid real estate financing feature that we are continuing to see being an important metric in data center financings.
So when you say kind of loan to value, I mean, that's got to be the amount of money that you're getting out of the loan versus the value of the real estate, right?
Correct.
Yeah, whereas in the project financing, typical sort of financial metric will be the debt service coverage ratio. So from the lender's perspective, their initial concern, or one of them, will be how do they get their principal and interest repaid, right? So on a monthly basis, that debt service, what is the project's capacity to pay it back? And is there some buffer there? So the DSCR is the debt service coverage ratio, measuring how much cash flow a project generates versus how much it's going to owe on interest and principal during a payment period. So basically, it just shows how comfortably the project can cover its regular debt payments.
So I guess just to unpack that a little bit, basically you're looking at, okay, if you've got $10 coming in the door and $3 of debt service payments every month, that's kind of the debt service coverage ratio you're talking about, Jared?
Yeah.
And basically making sure there's enough of a cushion there?
Yeah, exactly.
Yeah. Typically, it's measured as your CFAT, so cash flow available for debt service, which would be your total revenues less any kind of operating expense. And then depending on how the cash waterfall is structured, there might be some additional backing out of amounts going into your major maintenance reserves and whatnot. But that net amount against your debt service, and typically it's measured on a quarterly basis.
Got it. So data center financing obviously has got to be a lot different from renewable project financings, at the very least because there's no tax credits, right?
Correct.
Does that make it harder to do a project financing if you don't have the tax credits, you don't have that kind of automatic benefit, a lender could potentially take maybe out of tax equity financing, or does that make it easier?
Yeah, good question. I mean, not having the tax credits is actually simplifying, because then you end up with the project finance lender in the first lien position for the debt at the asset level. And then lenders don't have to worry about taking a back-levered position, relying on rights in a holding company to recover value on their collateral below. Caveat, if you're looking at solar or solar plus storage as a power source for your co-located generation for your data center, that may bring back the structuring issues.
Although obviously from your capital stack perspective, you don't have the benefit of tax credits. And so you're having to come up with more equity and debt in order to finance your project.
More equity upfront. Yep.
And just kind of out of curiosity off the cuff, I mean, the creditworthiness of the off-taker in these circumstances kind of weigh into how these projects get financed. I mean, if you have some elements of a traditional real estate project where you're kind of looking at the value of the project itself as part of the asset that you're lending against, I mean, does that make a big difference when you're looking at cash flows as opposed to, value of the assets when you're looking at the counterparty creditworthiness, or is it really just one way or another, you want to make sure that you've got a creditworthy counterparty depending on the size of the loan?
Ultimately, in project financing, you're looking at the creditworthiness of your off-taker. And you're getting into some mixing of project finance and real estate ideas here, because you could also be looking to the creditworthiness of your tenant, which would be slightly different, but kind of gets you into the same place if the hyperscaler is your tenant and they're going to back the project. So we are seeing a lot of, this is where the completion guarantee comes in, but we are seeing a lot of activity and sort of creativity from hyperscalers in finding ways to get into the capital stack or even take equity positions in other parties who are involved in the data center build out. And they're finding ways to use their balance sheet to de-risk the development of their data center projects, which obviously are core to their future business.
I would add there that we've also seen some of the hyperscalers provide guarantees to other entities who are the off-takers in contractual privity with the generator supporting the project, which is another way those hyperscalers have found a way to use their balance sheets, like you said, to support the project.
Basically, at the end of the day, with these data center projects, when you're looking at project financing or just financing multiple projects in the same project, generation plus the data center itself, at the end of the day, you're looking at the hyperscaler through and through to finance all of it, or their creditworthiness is backing the entire thing.
Yeah, I mean, there's the hyperscaler side of the market, right? And then there are smaller data centers with tenants that are themselves often smaller or more numerous and have perhaps shorter term time horizons or leases. And that, in that case, you're shifting your underwriting from like a single credit long-term contract risk to diversification and the churn of those entities and lease rollover risk. And that's why at a smaller scale, these projects look more like real estate finance than classic project finance.
Interesting.
Certainly at the hyperscaler end of the market, though, you're looking at project finance.
Got it. I guess taking a different tact here. I mean, we were talking about how, and Jason, you had mentioned that part of the project on the generation side is looking to a Google, a hyperscaler to supply that kind of that golden credit on the other side of the table. At the end of the day, like, are we talking about financing both a data center and a power plant together? Are we talking about financing them separately? I mean, or is it some combination of both?
Yeah, so far there's been a rush to get data center, the shell, financed. Given the power issue that everyone's been running into, i.e. power shortage, given the interconnection queues, it's expected to take many years, 3 to 5 year horizon, to get new power generation connected to the grid. There's now a lot of behind the meter power projects being developed, as we're hearing a lot about as well. And that's going to lead to, and we're hearing about, as of this year, financings of the behind the meter power generation projects to be financed. So we're talking about two different financings, although we're also hearing at the same time efforts to finance both the data center shell and the backup generator or the generation projects concurrently.
So I guess just to unpack that a little bit. So what you're talking about, Jeeseon, is there are two separate project financing facilities, one for the generation project, one for the data center, but they're being done concurrently because one piece doesn't happen with the other or without the other. You don't have a generation facility out in the middle of nowhere with no grid interconnection. And likewise, you don't have the same thing with the data center that doesn't have any interconnection at all and no power. So if I'm hearing you right, you're saying they are happening. It's not necessarily one big project financing altogether, but two separate projects that get done at the same time.
I think what we're hearing is either. So we're seeing also efforts to develop behind the meter power. And with that development effort will follow financings. At the same time, we're hearing about efforts to finance both concurrently under a single financing facility.
If you're financing both, I mean, it seems like you're just adding additional risk to both ends of the project.
Right. That creates what you would call project on project risk. And so things like construction schedule, you'll need to make sure all line up. If you're trying to get two projects financed effectively under a single financing facility, you will need to make sure that the construction risks for either of the projects line up.
So to add to that, it's like whether the project schedules and their contracts and their capital structures are all aligned. And then also with enough variance baked in that one doesn't sort of destabilize the other. So if you're focusing on during construction risks here, take timing. If data center is going to take a year or two to build, but your power source will be gas, and that may be like 3+ year timeline. If you start both at the same time, you have a year with the data center and no power, right? So you have debt service with no revenue, and that doesn't work. So you have to scope this all out to begin with.
But I don't think this is an issue that is unique to were you to finance both projects at the same time. Even if you were financing them separately, you would run into a similar issue, right? Where you want to make sure that the construction timeline and the structures all line up for the two separate projects and the two separate financings. Because again, the issues that Jared just raised around any kind of scheduling discrepancy is going to have, on the one project, is going to have an impact on the second project as well.
Absolutely.
So we've talked about project on project risk here, but what happens if the grid is delayed? How does that kind of flow through the whole project? If you are assuming that there's a grid interconnected data center, how does that flow through?
So Jared, I think you're right in this case to assume that we're talking about a generation facility that's interconnecting with the grid. One obvious way to manage this risk is by developing a behind-the-meter or islanded solution. But putting that aside and talking about grid-connected projects only, this is a fairly standard issue in all project financings for generation. So utility interconnection delay is a risk, not just in the data center context, but for project financings generally. Sponsors usually address that risk by providing in their offtake agreements that the timeline to develop the project is extended by any interconnection delay for which the utility is responsible, and usually some language that the seller is not responsible for. So literally what that usually means is a day-for-day extension of the relevant deadline for when liquidated damages start, an extension of the deadline for when the off-taker can terminate the off-take agreement, usually in each case by the number of days of utility delay up to a cap, 180 days, 360 days, whatever the parties negotiate there. So in other words, delay LDs don't start to rack up until after that extension, and the off-taker's termination rights doesn't kick in until after a corresponding extension to that date. So in addition to that, credit agreements and project financings typically will provide that COD must be achieved on a timeline that matches the timeline under the offtake agreement, including all the relevant extensions. So that timeline generally attempts to achieve a balance between the interests of the lenders and the off-takers on one hand, since the off-takers want their power and lenders want to deploy their capital, and the project on the other hand, which really doesn't have any control over those utility delays.
Jason, you were talking about delay LDs and kind of how that kind of flows through. So in a project financing, I would imagine classic project finance, you would flow LDs through from one party to the next. So if the generator is delayed and that's causing the data center to be delayed, the data center is going to owe damages or delay damages to the tenant, and then they're going to try and, data center owner operator is going to try and recover damages from the generator if the generator was at fault. But the economics here are completely different. So if that doesn't always line up, how are you seeing parties handle that kind of distinction?
Right. And I think that contrasts with what we are seeing under PPAs for data centers. So traditionally, those PPAs assess delay LDs based on some value lost to the off-taker by delaying the date on which performance begins. But in the data center context, the hyperscalers assess that value as the value of their business interruption if the data center is not able to operate, which is very different from essentially looking at your cost to cover if the generation is not there. And I think on the power side, that also contrasts with what we would expect EPC providers to bear as well, since an EPC provider is not going to be willing to bear those lost revenues by the data center as LDs under the EPC for the generator. Yeah, and I think the only way to resolve it is just very careful negotiations, splitting the baby wherever you can.
Well, and so from the financing side, if you're financing the power and the data center separately, you might, as a lender party, look to the LDs under the power to be sized for the power project and the LDs for the data center to be sized to the data center project. But if you're thinking of both as a unit and finding a way to finance both together, your co-located power and data center solution, then ultimately you care what the LDs are for the data center at the same time as you care what the LDs are for the power project, right? But the power project LDs are not going to flow through because they're not going to be sized according to the data center
That's right. And at least not under the traditional PPA construct. And that's some of the tension that we're seeing in the market right now.
Well, we're getting here towards the end and the end of our time here. And so maybe we can wrap up with just a couple of things. What are the key issues that a developer needs to consider in order to make sure that their project is financeable?
On the project side, key issue number one is, where are you going to get your power? Are you interconnecting to the grid? What's your plan for achieving that interconnect? Or do you have a co-location strategy or some sort of behind the meter power strategy until you're able to interconnect, or some mix of those things?
I would also add that having a financeable offtake. So on the data center shell side, that would be the lease with a creditworthy entity with our key financeable aspects.
And you want to structure your financings to mitigate project on project risk.
You got to make sure those schedules line up, right?
Of course.
All right. Well, really appreciate you guys joining us today. Jared, Jason, Jeeseon, thank you very much for your time. This has been another episode of Data Center Counsel. Have a good one. Appreciate your time.
Thanks for tuning in to this week's episode of Bracewell's Data Center Counsel podcast. To contact any of today's guests, please reach out to datacentercounsel@bracewell.com.